eligibility, we're here.
Woo-hoo.
We're here.
That's right. And exactly. And I know, Erin, you helped 200 plus people last year.
Yes, I did.
Fabulous.
On the way to at least another 200 more this year.
There we go. And I know we're going to have our discussion about smart choices about your health care.
I feel like that was a nice lead-in to it.
Yeah.
That was a nice few minutes.
Right, exactly. And that segment each week is sponsored by our very good friends,
Coventry Healthcare of Missouri and Aetna Company.
Okay, so while we're waiting for your calls, at 969-KTRS, star KTRS on your cell phones, or 1-888-550-KTRS. Let's talk a little bit more about creating security for yourself, feeling or a sense of security for yourself in volatile markets. And the truth is, we want the markets to be volatile. We want them to go up and down.
So on the down days, it's time to buy.
Exactly.
Everything's on sale.
Right, and most of us over our working lifetimes actually accumulate dollars by dollar cost averaging, putting money in once a month through our retirement plans once or twice a month, and so therefore we're buying on the up and down. What volatility means is that we also have the chance for upward return.
That's right.
Right. So, and at the same time, as you said, Erin, negative days create buying opportunities, which is kind of fun. So, but when we get right down to it, what are some of the things that we can do to reduce our, if you want to call it, level of stress when it comes to investing over the long haul, at the same time also to create more of a sense of security? I think there are basically 4 things we can do.
That's right. The first thing is rebalancing.
Really important, right?
That's right. At least generally once or twice a year is a good point to do some rebalancing. I know we rebalance in June and December every year.
Yes, we do. And, the rebalancing does a couple things. Number one is it gives you an opportunity, a chance to realize profits. Because what you're doing is you're taking money from the winners and you're feeding them either into generally cash or into things that aren't doing as well. Again, by rebalancing your portfolio, what you're also able to do in most cases is to moderate risk. That's the whole idea behind modern portfolio theory, which most advisors follow. It's an academic theory that basically says that by moving money across different asset classes, especially in the equities area, as well as in the fixed income area, not individual stocks, but actually different asset classes, large companies, mid, small caps, etc., international, emerging markets. What you're able to do is to moderate risk.
Which smooths returns.
Exactly.
And I also think that, when you think about it, the rebalancing helps you get your portfolio back into the correct risk tolerance that you desire, because naturally, especially in an up market when we've seen equities, the market was up over 25% last year. Naturally, as the market rises, you're going to start leaning more heavily towards equities, even more so than when you initially started. So what that does is it's able to shift your portfolio back into the correct balance for you.
Exactly, and that's what we had done at the end of this year.
And what? Also, the nice thing that we had done is that for our clients that are taking monthly distributions, instead of just reinvesting that rebalance, moving things back into place, what we were able to do was take some of those profits into cash and make sure that our clients had 6 months worth of their distributions available to them, so they don't have to worry about market volatility in order to continue to maintain their lifestyles. They know that 6 months worth of cash is available to them, and then they can watch the market.
Exactly, and so I think it makes days like Friday a little bit more palatable, as it would be, because we all love the ups. It's just the downs that give you a little hard.
Right, it's just staring at it.
Every once in a while. Exactly. So, that's important to do, and we've talked a lot about that this year, which is the value of rebalancing, of taking money and setting it aside. But there's also another reason why you might want to consider rebalancing your portfolio, and also maybe even planning, more importantly, for cash, which is if you have major capital expenditures. As a financial manager, Erin and I would tell you that anything that requires significant amounts of cash, which would be, we would think of these for non-recurring expenditures, maybe You're buying a car, you're redoing a kitchen, you have a wedding to deal with,
big vacation,
whatever it would be. Then it makes sense to identify that cash, that amount of cash that you need, put a date specific on it, and then when you get within 12 months, whatever that number is, that really should be sitting in cash.
Absolutely.
It shouldn't be invested because we don't want to put those dollars at risk, especially because you've already planned that expenditure, very similar to
a monthly distribution.
Exactly. And we like to call that filling jars. Right?
That's right.
Everybody has jars.
That's right. Or they should. And there are some cases in which we see clients or potential clients that are such excellent savers that we have to tell them it's time to start thinking about the fun things that you want to do in retirement, or the things that maybe you hadn't necessarily thought about, remodeling things, buying a new car, those type of things.
I mean, because we don't want to wait till we're required to take distributions if we don't need them at this point, because at 70, letting that money build up, then we know we do have to take the prime minimums from our 403Bs, IRAs, whatever it might be. So, again, 3 of those is, again, rebalancing your portfolio, planning for large cash expenditures, also planning for income needs, and then finally, maybe the most important one is the vault. Keeping your vault, keeping that cash reserve that you need available on hand, especially in your local commercial bank, savings and loan, credit union, whatever it might be, so that you can have that